So our next topic of conversation is limited liability companies, or often just called LLCs. Okay? And one of the reasons why the discussion of LLCs in the typical law school class is difficult is because almost every provision of the law that relates to limited liability companies can begin with, and often does begin with, the phrase, unless otherwise agreed, or unless otherwise specified by contract, or some other reference to a contractual arrangement between the persons who are forming the limited liability company. Limited liability company statutes and limited liability company cases that deal with the rule of limited liability companies are, for the most part, designed to support a general principle of freedom of contract and the enabling of contract. So, unless the parties have otherwise agreed, so done it by contract themselves through negotiation and a well-drafted operating agreement, this is what the rule is going to be. And most people who form a limited liability company, hopefully, do a decent job of setting out the rules for their arrangement in their operating agreement. That is really the challenge, the lawyering challenge. It's not to interpret some regulation or to know what the rule is that's being imposed upon you by a legislature, but to actually come up with a structure in advance consensually. Right? And that's a much tougher thing to teach by cases or by reference to some statute. And so what we're going to talk about in this short introduction to LLCs is the principal agreement that defines the terms of a limited liability company. The thing that's being referred to in all those statutory provisions that say unless otherwise agreed, and that is what is called the Limited Liability Company Operating Agreement. And the only question is, do I want it to exist under the default rules? And if I don't want it to exist under the default rules, if I want to set out for myself what the deal is about who gets to decide things, who are the members, how do members get to come and go, and all those issues that ought to get dealt with before we move forward, I'll need to enter into something called an operating agreement. Right? And now this one is called the Amended and Restated Limited Liability Company Agreement for Excella, because I did a short form, easy one when I first got started, but now that I'm actually up and running and I have a few members joining in, maybe I have a little bit of investment, I've decided to start from scratch and put in a more elaborate form. Maybe the truth is I used a form off the internet the first time, and now I've actually hired a lawyer, and the lawyer just doesn't want to deal with the messy thing or simplistic thing I started with, and so he's putting his own or her own form in place. Right? And the way you do that is you just adopt a whole new one, and it's as if the old one never existed. Okay. So, and what we're going to do is we're going to go through this form of limited liability company agreement pretty much provision by provision. Now, obviously, we're not going to go through every single provision, but I would like to just highlight a handful of them so you understand what the basic mechanics of an operating agreement are and what the choices are that everyone who forms a limited liability company are that you have to make. Okay. Okay, so this comes from the beginning of the operating agreement. If you looked at the rest of it, Article 1 is basically a whole bunch of definitions. So this is basically the first operative set of provisions in the operating agreement. And it starts with the obvious, right? This is a very common thing to state what the name of the entity is. And we see here again, I had put a comma in my little form, so that would have been an error. But these things should be consistent. This should be exactly the name that showed up in the certificate that you filed with the Secretary of State. Okay? And again, I mentioned that as the statute requires, and we're basically repeating what the statute requires, you have to include the words limited liability company or LLC in your name, and we've decided to go for the simple form, since otherwise all of us would start forgetting to put the periods, and that would be annoying to other people. We already talked about the role of the registered agent, and again, you recite that in your operating agreement. All right, and then here we talk about what the registered agent does, right? And we're talking about how they're there to basically serve as our mail drop for service of process in the state of Delaware. That's why Delaware requires you to have a presence in Delaware, because you need to be subject to Delaware jurisdiction for being purpose of getting sued, right, and for the purpose of establishing jurisdiction over you as an entity in the Delaware court. What might seem peculiar to you at first is how is it that a company that's not doing business in Delaware, in other words, doesn't have a actual principal office in Delaware, chooses to be a Delaware limited liability company and go through the rigmarole of hiring someone for $100 a year to be their presence in Delaware just for the privilege of being a Delaware LLC. And this requires a much more elaborate discussion. But the truth is that most, well, not most, but a very large number of entities that are formed for businesses in the United States are formed as Delaware entities. And in fact, a very significant source of revenue for the state of Delaware is the fact that it is the preferred jurisdiction for incorporation amongst all businesses wherever they happen to be located for doing business. So a company, let's say, that's doing all of its business in Philadelphia, it's a local business focused in the state of Pennsylvania, it may well still choose, for good reason, to incorporate as a Delaware entity. And the reasons people put forth for that preference is the fact that Delaware law is well understood, well developed, well settled, right? And has the benefit of a judiciary that is expert at interpreting issues and deciding issues related to business organizations, right? And so lawyers and their clients prefer certainty to uncertainty. And Delaware is also particularly well known to be a particularly sort of corporate-friendly, particularly management-friendly kind of jurisdiction. And so not only is it predictable, but it also tends to be favorable law, right? And so that's why people prefer it. So often venture capitalists, for example, will tell companies that for whatever reason incorporated locally, like in Wyoming, to reincorporate into Delaware because the venture capitalists and their lawyers just don't want to learn about the vagaries of Wyoming law, and they don't want to find out about what a Wyoming judge will do who's never faced an issue. And so they say, let's just deal with it by incorporating into in Delaware. And the beauty of that is suddenly now you get the benefit of Delaware law, right? Because the Delaware entity is subject to Delaware law for issues related to the internal corporate issues, corporate management discussions, corporate duty definitions of Delaware law, right? And so, but on another level, though, it adds another layer of complexities, because if I'm a Pennsylvania company doing business in Pennsylvania, but I'm a Delaware entity, right? So the business is really in Pennsylvania, but I'm incorporated in Delaware, I have to go through another step, and that's called qualifying to do business as a foreign corporation or company, LLC, in the jurisdiction where I am going to do business. And so I would not only have to file in Delaware to create Excella Technologies LLC, but if I'm then going to do business in Pennsylvania, I would have to qualify in Pennsylvania to do business. And that's another form and another fee. So everyone gets their take. But Delaware is a very popular choice, and so that's where we've decided to go. And we'll focus on Delaware law and Delaware operating company agreements for this course, because it is the most popular. Section 207 of the agreement states something that I think is at the heart of the choice to form a limited liability company, and that is you get your cake and eat it too. All right? As we'll discuss maybe in more detail, one of the great benefits of a limited liability company is that for tax purposes, you can elect to be treated as a partnership, and that's what this provision talks about. For tax purposes, you can elect to be treated as a partnership, but while that may be true for tax purposes, it is not true for corporate organizational business law purposes, right? And we're saying explicitly, right, that while we want to be treated as a partnership for tax purposes, we do not want to be treated as a partnership or a joint venture for corporate law or partnership law purposes. So there's no joint and several liability, right? But there is pass-through taxation for the purposes of tax. That's the cake and eat it too aspect of limited liability companies. This is the source of their popularity. So let's take a moment and review what we mean by pass-through taxation. Let's take two examples of two companies that are in the same exact business. One is organized as a LLC, and the other is organized as a corporation, or C Corp as they call it for tax purposes. Right? And we'll look at them having the same revenues of $100. Right? Each of them make $100 in their business, and their cost of revenue is the same, $60 in each case, right? Which means that they have a pre-tax income of $40 each, right? And so in all respects, the two businesses are exactly the same up to this point. They have the same sales, same cost of sales, and the same pre-tax income. And this is where the difference kicks in. In a corporation, that corporate level income will be subject to corporate level tax. And if we assume a 30% tax rate paid by the corporation, what will be left after the corporation has earned its pre-tax income and paid the tax on it will be $28. Okay. Now that $28 will then be available for distribution to the corporation's shareholders, right, who will then get the $28, and then they themselves will have to pay tax on that $28 because these days it's about a 15% tax rate payable on dividends, which is $4, which will mean that they'll have left in their pockets $24. Right? And so the owners of this corporation that holds the business that makes $100 end up with $24 after all is said and done after the payment of taxes. But if we go to our LLC instead and ask ourselves what the net result is, what we see is that pass-through taxation means there is no tax paid by the entity at the entity level. And so instead, the members here have distributable up to them, instead of a mere $28, they get the full $40. Now, because it's a pass-through tax, this income here, this pre-tax income, will then be attributable to the members, who then have to include it as income on their return, and they will therefore have to pay the larger 30% rate rather than the 15% rate on dividends, because there is at the moment a differential between the tax rates paid on income versus the tax rates paid on dividends. But even with that higher tax rate, let's say it's 30% roughly, our member has at the end of the day $28 left instead of a mere 24. And the reason that is true is because unlike the corporate business, the incorporated business, which has two levels of tax, that's what we mean by double taxation, right? Our LLC, because it's a pass-through, only has one level of tax, and so ends up with net more dollars in the pockets of its owners than the corporation. And that's the great benefit of being a pass-through entity. And that's what was so attractive about partnerships, and that's what's now so doubly attractive about LLCs, which can be treated as partnerships for tax purposes, but avoids the whole issue of joint and several liability. So let's review those provisions in the operating agreement that deal with what's probably one of the hardest things to follow in LLC formation and agreements, and that is the various provisions that relate to the economics of a limited liability company. And I have to say, frankly, it's the complexity that revolves around these provisions that causes a lot of people to shy away from limited liability companies and instead to use the corporate form, where the economic aspects of owning shares in a corporation are pretty straightforward, when we get to an LLC, and in particular LLCs that are electing to treat themselves as partnerships, the complexity that comes with the economic provisions tends to cause people to run away. And I think, so bear with me, because it actually isn't as hard as it looks. Although I'll caveat that by saying I would suggest that anytime you do an operating agreement, you make sure that some tax advisor is also involved in the drafting and review of the operating agreement, whether that be a tax lawyer that you're affiliated with or an accountant. Have someone walk through the provisions who understands partnership tax, which is something that most people don't. And so, but with that caveat, understanding the basics of how a LLC works and how the accounts inside of an LLC work is something any corporate lawyer should grapple with and come to grips with. And so let's start by doing some basic overview. So to begin with, when you become a member of a limited liability company and you put money in, unlike the consequence of being a partner where you now become obligated for the liabilities of the partnership, now you have limited liability, right? The money you've put in, unless you've agreed otherwise, is it. That's your exposure. And so we make very explicit that if it turns out that the company needs more money, you're not required to put it in, right? And that in fact, it'll be up to the board to figure out the terms under which any future capital raising effort will be made, and at that point, members will be able to decide whether or not they want to make additional contributions. But being a member initially does not come with that obligation in most cases, and that's explicitly the case in this particular operating agreement, and that's very common. Okay. So then, okay, so you've put your money in. Well, what do you get for that money? Well, here starts the complexity, all right? Let's assume we have a very simple case, okay? And that simple case involves a LLC that has 3 investors. We have investor number 1 who has invested $100 in a preferred unit. Okay, you will see in the form of LLC agreement that I gave you, there's this notion of preferred units. All right, we have investor number 2 who's invested $50 in a common units. He's bought $50 worth of common units. And investor number 3 who's also bought $50 worth of common units. Okay. And so in our LLC, what do these 3 people get for that investment? Right? What do they own? Well, what they own is a thing called a capital account, which is an accounting phenomena. It's a contractual phenomena. It's a way of keeping track of the economic interests of these respective people, number 1, 2, and 3, in the LLC. Right? And what it is a tally that you keep at all times about the partitioning of the assets and the net income and perhaps, unfortunately, net losses that the business experiences amongst the 3 investors, right? And it looks really complicated because it deals with a lot of complexity that relates to tax, right, and relates to different permutations of like assumed debt and things like that, which I think we shouldn't focus on. Let's strip it down to its core, right? And let's see that each member's capital account, right? So starts at a given number, and it starts with such member's capital contribution, okay? And in our case, that would be $100 for the preferred unit, $50 for the common unit, and $50 for the other common unit investor, right? And so just picking our preferred unit person, his capital account now consists of $100, right? That's their initial capital contribution. And then that capital account, over time, will grow. It'll get bigger, right? So we'll increase it by the amount of any net income allocated to the member. And this other stuff we'll not focus on for the moment. But net income right? And what is that? Well, that's the profit that the business generates, right? And to the extent that we allocate to the preferred holder net income, right? So at the end of the year, if the company has made $100 and the preferred shareholder's share of that $100 is 10, well, that preferred shareholder's capital account will go up from the original 100 he put in to 110, okay? And so his interest now in the assets of the business, if it were to go into dissolution and liquidation, would be 110 over what everyone else's claims are, right? All right, and then let's just not worry about this for the moment. This is a complexity that we are rarely going to deal with. All right, so the basic idea is whatever you put in plus whatever your share of the profits is will be the plus side of your capital account. Okay, and the negative side, right, is minus whatever amounts you get distributed. Okay, so and the notion in corporate law, corporations is a dividend, and in LLC we call it a distribution, right? So if you put money in and the company makes more money and some of that money gets sent out to you, you get it in your hands and you can go spend it, right? That's a distribution. Well, that will reduce the account. So if you have $100 in, you made 10 bucks as a business, and out of that 10 bucks we decide to distribute $5 to the preferred shareholder, well, now his capital account, which was 100, goes up to 110, will go down by the 5, and so you'll be left with 105, right? Because if you get the money through a distribution, you can't get it again if there was some kind of subsequent liquidation or dissolution, okay? Now, we have to deal with the possibility that instead of having income on any given day, we had losses. And the reason why we deduct losses from your capital account is because the cash that got lost had to come from somewhere, right? The business is now worth less, and so that diminution in value has to be allocated amongst the owners, right? Because if the business started at being worth 100 and it lost 10 bucks and now worth 90, that means that that loss of $10 has to be distributed or allocated across all the members so that we know how that $10 disappearance is being shared by the various members, okay? And that's the way we do it. We allocate net losses across the members. And so if instead of making $10 that year, we lost $10, our original preferred holder gets allocated $2 of that 10. Well, they started with 100, there was no net income, there were no distributions, and we're allocating $2 of the loss, and so he'll now be left with $98 of a capital account. And again, let's not worry about assumption of liabilities. That's a detail that just adds unnecessary complexity. Let's focus on starting capital distribution, contribution, net income, minus distributions, minus net losses. That's a basic formula you should keep in mind. Okay? Let's write that down. Capital account contribution plus net income share, right? Minus distributions, and then minus net loss shares. All right. And that equals your capital account. Okay. We clearly see that it's important to figure out, in order to know what someone's capital account is, and therefore what their, if you will, economic stake is in the LLC, because that's what capital account measures. It measures what you would get if the LLC were to be dissolved, right? And so it's your tally, your scorecard, if you will, for what part of the business it is you actually own, its economic value that you own. So that means that understanding how you figure out what your net income share is, right, and or your net loss share is pretty important, right? There have to be rules that tell you, well, if the enterprise made $100 or lost $50, how much of that $100 or that $50 is going to be allocated to your account, because that's what's going to affect your economic interest, right? And so, of course, there's a provision in the, a very daunting looking provision in the operating agreement that talks about it. And it says, you know, for each year, So we'll look at the end of the year how we did, right? Net income or net loss, right, shall be allocated among members, right, in a manner such that, and here's where it gets ugly, right, let's ignore for the moment these parenthetical phrases, in a manner such that the capital account balance of each member, right, so then that the net result, immediately after giving effect to such allocations, so after we do this calculation we're doing, so in other words, what this ends up being based on what we decide the share is here, right, is as nearly as possible equal to the distributions that would be made to such member pursuant to blah, 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 meaning the winding up provision, if the company were dissolved. Okay? So that seems like a tautological statement, right? It's a circular, right? You figure out what your share is by figuring out what your share is sort of what it seems to say. But actually that's not the case, right? And we'll see in a second what that means. The way to look at it is by referring to what the distributions would be. And we have another section that tell us what the distributions are. And so let's look at that for a second. So, distributions in liquidation, which was the rule we were supposed to apply in figuring out how we allocate net loss and net profit, requires us to do one thing first before we get to look at this, what we call waterfall. And that is, the first thing we do is we pay off all of our debts, right? And so in liquidation, you take whatever money there is and you pay it off, you pay off whatever creditors you have. But let's assume we've done that already. Or let's assume we're dealing with a limited liability company, again for simplicity purposes, that does not have any outstanding debt obligations. And so all we're dealing with is the sharing of what's left amongst the members. Okay? And this is a very typical, what we'll call waterfall. Now you can set the waterfall differently if you want. Again, you can actually set it any way you want. Now whether, and I've mentioned this earlier, it's something that gets respected by the IRS for the purposes of taxation is a different story. But as a matter of LLC law, you can write this any way you want. You could say that even if you've put in $100, you get nothing back. Even if you put in twice as much as the other guy, you share equally. You can do that, but the IRS may have some view on whether that is should be respected for tax purposes, but for LLC law purposes, that's fine. Okay? But what we have here is a much more typical waterfall, and one that's designed not only to be probably economically rational, but also to follow what the tax people would expect, and that is the distribution follows the relative economic interests of the persons who've invested in this company. And the way it works is we have, as you remember, two kinds of units: preferred units, right, and then common units. And the difference between a preferred unit and a common unit, which we happen to set up, and you can do this any way you want, but in this case we set it up, and it's a very common setup, is that preferred units get paid first. They're entitled to their distributions to get their money back before the common units get their money, or are entitled to any share of the profits being sent out to them. And the reason why that makes them preferred, i.e. they're preferred for payment, is because they're safer, right? Since they have first dibs, they stand higher in the pecking order, and therefore they are more likely to get their money back and to get their yield back than the common units, who bear all the so-called residual risk. Okay? And so for that reason, they have what is called a yield, right? And if you were to go to the beginning of our form of agreement, you'd see that this preferred unit gets a fixed rate of return on their investment, right? The common units don't get any designated return. They just get what's left over. And that number could be less than what they put in. It could be many multiples of what they put in. It all depends on how the business does. But these folks, the preferred unit, are entitled to get their money back before the common gets anything, and to get a fixed rate of return before the common gets anything. So in exchange for this greater certainty, okay, and for this preferential claim, they've exchanged upside. They don't have an unlimited upside. They have a fixed upside, but it's more secure, and that's the trade they made. Certainty for a lower yield, right? Very common trade. Less risk, more certainty, right? And so the way the waterfall reflects that economic deal is it says, hey, if there's any money to be distributed, the first thing you got to do is give it to the holders of the preferred until they've been paid their yield, right? So in this case, I've forgotten, but let's assume it's a 10% stated yield. So unless our guy who put in the $100, if it's a year later, gets $10, the stated 10% yield, you can't give any money to anyone else. So the first thing you got to do is pay out the $10, right? The second thing you got to do is you got to pay out their capital contribution. So he gets his $100 back. So if there's any money to go out the door, first it goes to pay the $10, then it goes to pay the $100, and then only then does it start being used to pay back the common units their $50. So each of these folks would get pro rata distributions of whatever's left after you've paid out $10, $100. You can start paying out these $50 buckets sort of even Steven, right? So if there was only $10 left, they'd each get $5. If there was $100 left, they'd each get $50. But then if there was $1,000 left after you've done all those distributions, they would then split it, right? Because that's this idea of the residual interest. The common gets everything that's left over after you've paid back the preferred, their yield, their principal back, their capital contribution, the capital contribution to the common holders, whatever's left, assuming you've managed to create money out of the original investments, belongs to the common. Okay, and that's a typical waterfall. And you'll remember that the reason why we're studying this waterfall at this point is because that waterfall was what told us how we allocate net income and net loss. Remember, we're supposed to allocate net income and net loss so that as if we were to do a distribution based on capital accounts, right, that those capital accounts would be consistent with what this waterfall tells us to have done. Okay? Now it's a lot of words, but I think I need to give you a sort of a quick example of how that works. Okay? So let me do that. Let's assume we still have our three investors, right? We have a $100 invested by preferred and two $50 common unit investors. Okay? And let's start at the very beginning, right? And use our, right? We have the preferred, the common number 1, and the common number 2. And their capital accounts, if you'll remember, consists of their capital contribution. And what's that? This person put in $100. This person put in $50. And this person put in $50. Okay? And now the next question is, what is their net income share? And let's assume that we're at the end of year 1. And in that year 1, the company lost $50. And that loss consisted of two things, right? And we'll look at the company's income statement, right? From operations, they lost $40. And then because they owe, and this is not actually a part of the loss, but because they owe a preferred, they owe a dividend on the preferred stock, so we'll call that the preferred yield. They lost $10 there, right? That was the 10% the preferred gets. Okay, so they lost $40. Okay, that $40 does not get allocated to the preferred, right? Because the preferred is entitled to, in our distributions section, and there were no distributions. No net income, no distributions, but we're talking about how to allocate net loss. The preferred does not suffer any of the net loss, and in fact they're entitled to their $10 of yield, right? So this guy actually goes up. Goes up $10, right? But each of these guys who have to cover the $50 of total net loss, the operating loss, and then the $10 to cover the preferred's $10 stated return, they suffer a negative $25, right? Half of this each. Loss in their account, okay? And so at the end of that year, what are the capital accounts? Well, our preferred got 110, and these guys got to 25, right? Because the company lost a total of 50 bucks, okay? So that's how the capital account worked, and how the capital account was in fact driven by the assumed distribution that would occur if in fact there was liquidation. Or let me give it to you slightly differently, right? The company started its life with a total of $200 in cash. That's its only assets, right? It got $100 from this guy and 50 from each of them, at $100. At the end of a year, it managed to consume in its operations $40 of cash, right? And so its total asset base at this point is what? $160, okay? Because it's the 200 it started with minus the $40 it spent in running its business, because it didn't make any money, it spent money, okay? This $10 yield is actually not a cash expense. We haven't spent it, we haven't sent it out to anybody. But it is a capital account that we have to take into account, because the preferred guys are entitled to it, right? They had in their document, I get 10% a year, right? Come what may, all right? And so, but it wasn't actually a reduction in the assets of the business. It is simply a movement of value from these guys to this guy. So he gets the 110, right? And so when you add these up, I have $110 worth of claim against the assets, and these guys each have 25. That adds up to the 160. And so if we were to now liquidate the company, because all it has in it is $160 of cash, 110 would go to the preferred shareholder, and 25 each would go to the common shareholders under this scenario, right? And so that's how the capital account mathematics works. And you can see why being preferred is perhaps a good deal, at least in the loss-making scenario, right? Even though the company lost money, he made his 10% return. Okay, so let's take our first year here and roll forward a little bit, okay? And let's assume now, because we got that, we're now in year 2, okay? And we move down our capital accounts from year 1, so this guy's now at 110. In the beginning of the year, these two are at 25, right? And we had $160 of assets in the business, okay? And let's assume that instead, and we're going to use these same criteria, right? So we'll put capital contribution, net income, distributions, and net loss, okay? And we're going to assume that there's no net loss in any of these, in this context. There are no distributions. There are no further capital contributions. And so all we're focusing on is net income this time. And this time the company has generated in its operations $100 of profit, of net income. Okay. So how does that $100 get allocated into the capital accounts of our 3 investors? Okay. Well, our preferred person is entitled now to a further specified yield, right? It was 10% per year, right? And $110, 10% of that is roughly 11 bucks. Okay. And so out of that 100 bucks, 11 of it's going to get allocated to our preferred holder, because now if we were in distribution in a liquidation, remember the waterfall was preferred return, a further 10%, and his money back. And so we would have fully covered his rights in distribution if we pay him $121, right? Because that covers 2 years worth of 10% return plus getting his money back, okay? And then that leaves $89 to distribute between our 2 common holders, right? So remember, they're entitled to getting their $50 back plus anything that's left over. And so that means they get to share all that's left, right? And in this case, $89 is $44.50 each, right? And that leaves them with $69.50 each as a capital account, right? And that totals up to $260, right? Well, this plus this plus this equals 260, right? And well, 260 is the same as the now present assets of the business, because we assumed we had $100 more cash from operations and we started with 160, so that all ties together, right? And so that's an example, a simple example of how capital accounts get kept when you have 3 shareholders, one being a preferred. You have the first year of losses, which were borne by the common shareholders, and then the second year of income, which again were borne by the common shareholders. And now it shows why it might be fun to be a common shareholder. While it was great in the loss-making year to have the sure thing of your fixed return, when you start making money, it suddenly starts looking good to be a common shareholder because your upside is unlimited. You have the residual claim. That's the basics of how a capital account works. If my capital account is $69.50, can I walk into the corporation, or I'm sorry, to the limited liability company and present my shares and say, give me my money? And the answer is no, right? Generally speaking, the power to grant distributions of the money that's been accumulating inside of an LLC belongs to the board, which has the sole discretion regarding the amounts and timing of distributions, right? And so the board holds these capital accounts captive in most cases, with some rare exceptions, until they decide it's time to make distributions. And when they decide it's time to make distributions, they have to go back and look at the rules for the waterfall. And so let's say our board looked at its bank account and said, oh my goodness, we have $260. That's way more than we need. Let's send 100 of it out. Okay, we're going to make a $100 distribution. Well, what would they have to do? They'd have to go look at this and say, well, after making all distributions made up pursuant shall be in the following manner, the waterfall. First to members pro rata in proportion to their holdings of preferred until you've paid the preferred unpaid yield. Well, at the moment, that unpaid yield is 21 bucks, I'm sorry. So we'd have to pay $21 yield to preferred. Okay. And then we'd have to pay the remaining $89 to the preferred as a capital return. Okay. Which would leave nothing for the common. Okay. But what would that have done to our capital account? Well, if we paid out this distribution, we'd have eliminated, we'd have reduced this capital account from 121 by 100 down to 21. Okay, right? And so now, in another year's time, what would the capital account of this preferred holder look like? Well, now he would have gotten $2.1 worth of yield. Right? And in the following year would have had 23.1 of capital, because by reducing the base capital by $89, we reduced the required yield accretion on that preferred for the given year. Okay? And so you could see maybe the best thing to do is, rather than send out a dividend of 100, if you want to send out any dividend, you'd send out a dividend of $121. That would get rid of this capital account altogether, which in turn would get rid of this and this, because we've fully satisfied those steps in the waterfall, and every dollar thereafter that would be available for distribution would now belong to the common. Okay? But that's how money gets sent out. In the end of the day, what matters is to realize it gets sent out because the board decides it gets sent out. And once they decide it gets sent out, it gets distributed in this kind of waterfall method that's defined by these sections. Okay? Okay, it's like filling up teacups in the one very common thing you write into your agreement is this section. And it basically says that the board does not have the discretion to withhold distributions of net income, right? To the extent that you need that money to pay your taxes, right? Because you'll remember one of the consequences of pass-through tax treatment is that the income of the entity does not pay tax at the entity level, but instead gets transferred up and triggers tax at the shareholder, or in this case, member, LLC member level. Okay? And since there is no obligation on the part of the LLC to ever distribute the actual net income that is attributed to the member for tax purposes, if you're a member of an LLC and you are allocated $40 of income, you may never get those $40 absent an agreement to the contrary, but you still owe the $12 worth of tax. So that can be a very rough thing, right? You can be investing in this very successful limited liability company, but because of the pass-through tax treatment, you're shelling out dollars every year in order to pay the tax, but not getting any dollars from the very successful business to pay that tax. And the solution to that, which is very common, is to provide an obligation on the part of the company to pay out an amount every quarter that's sufficient to pay the tax that is likely to be owed by the members on the income of the LLC. Right? And that's a very important provision to focus on, because otherwise you may have created a cash flow disaster for your members. Right? But absent that, the rule is distributions are at the discretion of the board. And so that's something that the business people need to think about when they're setting up their operating agreement. So the next set of provisions deal with the question of how is our limited liability company going to be managed. You'll remember that in the case of a partnership, the partners are all agents for the partnership and can bind the partnership, and therefore the way a partnership acts, the way it takes action, right, because a partnership as such can't do anything, it has no arms or legs, is by having its individual partners go out and as agents do things, right, enter into contracts and so on. That is also possible in a limited liability company. It can be that the members of the limited liability company are, like partners, agents of the LLC. But in this case, and this is actually quite typical, we provide that the members are not agents, right? And that, except as provided, no member as such has the power to act for, on behalf of, or to bind the company, right? So then the question is, okay, if it's not the members, who, right? Well, the answer to that question of who it is who can enter into an agreement that binds the limited liability company has to be found inside of the four corners of the operating agreement, right? And so let's take a look at what we have provided for in this particular case. Here we have a provision that talks about the establishment of something called a board of managers. Okay? And this concept of a board is borrowed from the corporate context, where the law actually requires that corporations in most cases be managed by a board. That's not the case in a limited liability company. In fact, it's possible for a limited liability company to be managed by its members and have no such notion of a manager or a board. But very commonly, this solution is adopted where you create this notion of a governing body inside of the entity that is representative of the interests of the various owners. Right? Now, the question then that's posed is, well, if you've created this thing called a board, how do you decide who's on it? And that's what Section 802 says. Now, I don't provide you a copy of 802 here, but you can go look at a section in the example. But the point is that that provision can say anything you want. Right? It could say that all of the members of the board are picked by Mr. X. It could say that if it's three members, that one is picked by Mr. X, one is picked by Mr. Y, and one is picked by Ms. Z. It could say that the members are picked by the vote of the holders of a majority of the outstanding units, right? You can have it be that some bank picks one group and that some other group picks another group. It's completely wide open how you provide how a board of managers get picked. But what you are doing is saying that this entity possesses this power, the full and complete power and authority and discretion to take actions that bind the entity. right? So I guess, is that the answer to our question? Well, if we want to enter the agreement, we have to have the board agree to do that. Okay, that sounds a little unwieldy. And then if in fact what we decide is that it should be the members who pick the board, which is a common solution, how do they in turn act? Right? Well, in this agreement, we find an answer to that. Right? We have a provision that deals with how members can take decisions, right? And we require them in this case, and again, this is borrowed largely from the corporate context. We ask them to get together in a meeting, and at that meeting for them to be enough of them so that we have a quorum, and in this case we define quorum as the presence of members holding a majority of the outstanding voting units, right? We could have chosen it a different way, and in fact the default rule in many jurisdictions is it's a per capita rule, where it's a majority of the members and not dictated by how much stock they own or how many member interests they own, but how many of them there are there. So if there are 5 members, you need 3, right? Even if one member owns 60% of the units, you still need a couple more to get to a quorum. In this case, if that were the case where you had one member who owned 60% of the units, he alone would form a quorum because we define quorum by how many units you own, not by the number of members. Again, then we also provide, well, if you have a quorum, how many of them have to vote in favor of a particular matter to act? In this case, again, we stipulate a majority of the outstanding units. We could have written that many different ways, right? Many different ways. This provision you'll see often in an operating agreement that provides for the ability for people to act not by getting together, but by a writing or by email, a very practical thing. And again, that's permitted and is something you need to provide for in your operating agreement. But let's assume that we had a rule that the board would get picked by majority vote, majority of the outstanding units. We had a quorum of that outstanding units gathered. They in fact voted by majority of the outstanding units to pick a particular board, and that board is now in place. So how do we know now whether or not we have an agreement? Well, we'd have to then ask ourselves, did that board that the members picked act in favor of the agreement? And the question is, how does a board act, right? And let's assume for the moment that we have a board of 3 members, right? And this provision that you would find in a typical agreement, and again, it's borrowed largely from the corporate context, says that you need a majority of the managers to show up in order for the board to act as such, for there to be a quorum again. Same notion as we saw in the member voting provisions. Out of 3, you need 2, because that's a majority. And so then the question is, how many of those 2 have to agree in order for them to act? And we see here a requirement that says you have to have a majority of the members who make up the quorum act. Well, a majority of 2 is 2, because 1's not enough. And so we would need both of the persons to get together. But if we had a board of 5 and only 3 people showed up, you'd only need 2 of those 3 people in order to get the deal done, right? And so that's the difference between board action and the way we set up member action with these different voting requirements. But again, you can do it any way you want, as long as it's set out in your operating agreement. Okay, so again, have we gotten to the bottom line of how we figure out whether the agreement can be signed and with whom we should be signing it on the other side? Is that really what we expect, that we would go through all this rigmarole to make sure that, hey, in fact, we had 2 out of the 3 members of the board involved, right? Well, the more typical answer is this, right? What actually happens is we have a board that gets elected by members, and then we have a board that gets together and forms a quorum, and then by majority vote, that board adopts a resolution which authorizes an officer to go execute an agreement. Okay? And those officers are people who were appointed by the board previously to serve as agents of the entity, and to whom the board periodically delegates authority, like by passing a resolution approving a particular transaction, to go out and do on behalf of the entity, the limited liability company, what the entity needs to do. Right? Very similar. We'll see this is very similar structure and a pattern that gets used in the corporate context. Okay. All right, so that's how this particular LLC decided to be managed. You could have chosen to have one of the members manage the entity and one of the members to have the power to enter into contracts and to act on his own. It could have been as simple as that. But again, it all depends on how you write your operating agreement. Some other provisions that are worth noting in respect of how an LLC is managed relate to what officers and managers do not have to do or are not responsible for when they are acting on behalf of the limited liability company and acting on behalf of or at the behest of members, right? Those, we have this definition of so-called covered persons. It talks about everyone basically who's involved in the LLC, but in particular it's talking about managers and officers and their responsibilities to the members and members to each other. And what it says in this particular provision, which is a very common so-called exculpation provision, says that none of those folks are going to be liable to the company or to each other for anything that gets done, damages, if the reason that damage occurred is something that the person did in good faith with the belief that the action was in the best interest of the company and did not constitute fraud, gross negligence, or willful misconduct. So in other words, unless it was something intentional or almost intentional and the person didn't believe it was something that was in the best interest of the company, right? Then you can hold them liable for what they did. But otherwise, if you don't meet that fairly low standard of behavior, they are not responsible for what they do vis-a-vis the company or the other participants in the company. Right? And what is this? This is a weakening of the fiduciary duty of care that we saw in the context of agency and in partnership. And it is a symptom of this larger agenda in LLC land of freedom of contract, right? What the notion is that if parties want to, they should be free to contract away even things like fiduciary duty, right? Because maybe that's what they want. And if they're well advised and grown-ups, why shouldn't they be allowed to do that, right? In fact, it goes even further to say that all the liabilities that might be imposed, like fiduciary duties, are not, right? And they're in fact being waived, right? And that all that is being imposed on covered persons under this agreement and by reason of their participation in the company are those things that are specifically specified in the agreement itself. So for example, Cardozo's punctilio of an honor the most sensitive, out the window, right? The duty of loyalty, out the window. The ability to compete against your LLC, not a problem, right? Unless they're specifically provided for as specific requirements under this agreement. This catch-all says none of that applies, except perhaps to the extent that you go so far as to commit fraud, right? This is an example of why LLCs are so popular, particularly by those people who create them and manage them, is that it allows you to go further than most people think you can go in the corporate context to set the terms of your relationship with the owners of the business and with the other people involved, and to make as minimal as perhaps possible the judicial intervention or the ability for courts to impose some kind of set of duties that are not specifically set out in your agreement. That's why these agreements are so important. Right? They can really set the standards by which all conduct is going to be measured inside of the business.